A Chinese metals trader just vanished into thin air with at least $144 million. And the Chinese government is absolutely panicking right now because this isn't just some random scam. This is exposing a massive hole in how China's entire commodities market actually works. His nickname? The Hat. And before he disappeared, this guy was at the center of a trading network that involved state-owned companies, banks, and metals worth over $1 billion. Now regulators are scrambling. Lawsuits are piling up, and thousands of tons of copper are literally frozen in warehouses while everyone tries to figure out who owes what to whom. But here's the thing. This isn't just about one trader going rogue. This is about a practice called circular trading that's been propping up China's metals market for years. And now that the Hat has fled the country, the entire house of cards is collapsing. So stick around, because by the end of this video, you're going to understand how this scheme worked, why it matters way beyond China, and what this tells us about the financial risks hiding in plain sight in the world's second largest economy. All right, let's start with the man himself, Xu Maohua, born in 1972 in Baiyun, a city in northwestern China. He got his bachelor's degree from North China University of Technology in Beijing, then started his career trading recycled metals in Guangdong province. Over the years, he built up a reputation. He expanded from recycled metals into refined metals and concentrates. Copper, zinc, indium, you name it, he traded it. And somewhere along the way, he picked up the nickname The Hat, because his given name, Maohua, sounds like the word for hat in Mandarin. He even used it as his WeChat handle. Now, here's where things get interesting. Xu wasn't just some independent trader doing deals on his own. He was operating a network of companies. And these companies were acting as middlemen between metal smelters and China's massive state-owned enterprises. And that's the key detail here, state-owned enterprises. Because in China, these SOEs aren't supposed to be trading metals for fun. They have strict rules. They're only allowed to trade raw materials that are necessary for their core business operations. But Xu found a way around that. Here's how the alleged scheme worked, and this is where it gets wild. Xu's companies would buy metals from smelters or other traders. Then they'd resell those shipments to state-owned enterprises. But it wasn't a normal sale. Part of the deal was a commitment to buy the metals back at a later date. So on paper, the SOEs were buying and selling metals. Revenue goes up. It looks great in the books. But in reality, the same metals were just circling back and forth between the same players. This is what regulators call circular trading. You're creating the illusion that business is being done, that revenue is being generated, when really you're just moving the same assets around in a loop. But wait, there's more. Because Xu wasn't just circulating metals, he was turning these trades into immediate cash. How? Through something called invoice factoring. As soon as Xu sold metals to a state-owned enterprise, he'd get an invoice, and he could sell that invoice to a bank or factoring company at a discount before the metal was even delivered. Boom, instant cash. The banks were happy because they were buying invoices from legitimate state-owned companies. The SOEs were happy because they were boosting their revenue numbers. And Xu was happy because he was getting cash flow immediately. Everyone wins, right? Wrong. Because according to people who did business with Xu, some of the metals he was trading weren't actually his to sell. And many of the companies involved in these transactions, he owned them himself. So you've got one guy controlling multiple entities, moving invoices and metals back and forth, creating the appearance of legitimate trade when it's really just smoke and mirrors. Now, the Chinese metals market has seen scandals before. In fact, there was a case involving fictitious stockpiles of aluminum that caused over $1 billion in losses. The trader in that case got sentenced to life in prison last year. But Xu's situation might be different, because some people close to him say his finances unraveled after a separate bet went horribly wrong. He apparently bet that silver prices would fall. They didn't. Silver prices have doubled over the past couple of months. And if you're on the wrong side of that trade with leverage, you're cooked. So Xu did what anyone in his position might do if they're looking at catastrophic losses and potential criminal charges. He fled China, and that's when everything started to unravel. The most high-profile victim, SDIC Commodities. That's a trading unit of State Development and Investment Corporation, a government conglomerate with annual sales of nearly 200 billion yuan. SDIC owed money to suppliers because Xu owed money to SDIC. And when Xu vanished, that chain broke. One company, Guangdong Proto Supply Chain Management, has already sued SDIC for 219 million yuan. They say SDIC failed to fully pay for shipments of metal concentrate. A court in Tianjin separately seized 3,150 tons of refined copper that SDIC was holding in storage. Frozen, just sitting there while lawyers fight over who owns what. And while there's no official total yet, people directly involved in these deals estimate the losses could be at least 1 billion yuan. That's $144 million. But some insiders think the real number could be way higher based on the scale of trades they've seen over the years. Now, you might be thinking, okay, this is bad for the companies involved, but why should I care? Great question. Because this isn't just about one trader or one company. This is exposing systemic risk in China's commodities markets. And China is the world's largest consumer of industrial metals. When there's instability in Chinese metals trading, it doesn't stay in China. Copper prices, aluminum prices, zinc prices, these are global markets. If Chinese state-owned enterprises are suddenly pulling back from trading because regulators are cracking down, that reduces liquidity. Less liquidity means more volatility. More volatility means uncertainty for everyone from construction companies in Australia to electronics manufacturers in Mexico. And here's the kicker. China's state-owned assets watchdog has already responded. In recent weeks, they've ordered major commodities trading companies to review their operations and eliminate what they call superfluous activities used to boost revenues. Translation, stop the circular trading. The problem? Compliance has been patchy. These restrictions were first imposed in 2023 after a debt crisis at a state-owned timber company. But with China's economy slowing down, it's been really tempting for state firms to find creative ways to generate revenue. And now, with the hat's disappearance, regulators are realizing just how widespread these practices might be. So let's zoom out for a second. What does this tell us about China's economy? First, it shows that even state-owned enterprises, companies that are supposed to be the most stable, the most reliable, are engaging in risky financial engineering to hit their numbers. Second, it reveals that Chinese regulators don't have full visibility into what's happening in their own markets. If a single trader can create a network this large without triggering alarms until he literally flees the country, there are serious gaps in oversight. And third, it's another data point in a growing trend. China's economy is under pressure. Factory activity just unexpectedly deteriorated in January after snapping its worst contraction streak on record in December. Companies are desperate to show growth, even if it's artificial. The hat didn't create this problem. He just exploited it. And now that he's gone, we're seeing how fragile some of these trading networks really were. As of right now, Xu Maohua hasn't responded to any requests for comment. His social media accounts are silent. His business contacts in China aren't talking. He's in the wind. But the mess he left behind, that's just getting started. More lawsuits are coming. More frozen assets. More uncomfortable questions for Chinese regulators about how this was allowed to happen in the first place. If you want to stay updated on this story and other finance and geopolitics news that actually matters, hit that subscribe button. I break down complex global events into clear, no BS analysis multiple times a week. And drop a comment below. Do you think China can actually crack down on circular trading? Or is this practice too embedded in how their markets work? Thanks for watching. I'll see you in the next one.